Okay, hello everyone. And on behalf of the Oxford University Centre for Business Taxation, welcome. My name is John Bella, and I am Deputy Director of the Centre, as well as Professor of Law at the Faculty of Law here at Oxford. I'm delighted you have all joined us for the launch of Richard Collier's book, Banking on Failure, because this book deserves to be richly celebrated. So today's event will be chaired by Jenny Strasberg from the Wall Street Journal. But before handing over to Jenny, I'd like to say a few words about the Center for those of you who are new to us. So the Center for Business Taxation is an interdisciplinary research center housed at the Saïd Business School at the University of Oxford. It is made up of researchers from economics and from law, and its director is Professor Michael Devra, who many of you will know. And as I said, I am a deputy director here. So what do we do at the center? Well, first and foremost, we undertake academic research on business taxation that aims to move the frontiers of our knowledge in this area forward. But we also engage actively in policy debates. And there is a symbiosis between these two activities. So current policy debate influences our academic research questions, and our academic research informs our contributions to policy debates. And finally, the center also runs a part-time MSc in taxation in partnership with the law faculty. And again, our teaching on the MSc is informed by our academic research and policy engagement. So Richard Collier at the moment is an associate fellow of the center, and his work on financial sector taxation, I believe, exemplifies the very best of our different activities. So Richard has undertaken first-class, cutting-edge academic research in this area, as can be seen in this book. It has used this academic research to inform his policy engagement and recommendations. And he uses this academic and policy work when teaching a really fantastic course on the taxation of corporate finance on the MSc in taxation. Now, those of you who know Richard well will know how extremely modest he is. So I hope he can forgive me when I say that Richard is an extremely learned and all-round wonderful colleague, and this is an extremely learned and all-round wonderful book. By the end of this event, I am certain that you will share my view that there is much that we and policymakers around the world not only can, but should learn from this book. So welcome once again, and I will now pass over to Jenny Strasberg, who will chair this book launch. To you, Jenny.
Thank you so much, John, and thank you to the panelists, and thanks to everybody dialing in, and hope everybody's well in situations that don't look like they're getting any easier anytime soon. So I was asked to just say why you're looking at me while I'm here. So very quickly, I moved to London in 2013. As you can tell, I'm not from here. And the Wall Street Journal basically gave me a mandate of find important stories, bring them to our millions of readers, and if we do the job well, we'll illuminate something new about the world. And I've got a penchant for trading and traders and banks and the financial system, so that's what I've covered for a long time. And I started hearing very quickly about these trades called dividend arbitrage trades, which were pretty much stamped out in the US, but lived on in London and in Europe, but weren't really getting a lot of attention. So I decided, well, that's interesting because there were American banks involved. And, so I tapped my contacts and started writing about that. And lo and behold, I start getting emails and phone calls from mysterious, confidential, like anonymous people saying, you don't know the whole story. You don't know the whole story. And what they wanted to tell me about were COMEX trades. They said, you've got dividend arbitrage, you've got that's like the vanilla version of this other thing that you really should pay attention to. And over time, these bankers, traders, lawyers who, were kind enough and trusting enough to take me inside the world of COMEX, essentially kind of gave me a look at, they spent hours explaining how these trades worked. And I'm not going to do that because Richard's going to do that. But thank goodness, I wish this book had existed when I started covering this, because it was like a mind bender. It was like taking statistics course in business school. You know, you just had to like think in a different way. And so there were these really big players who treated CumEx like it was essentially this vault that had been accidentally left open. But the vault was full of taxpayer money, and they wanted to just try to get as much as they could as quickly as they could. And I was coming at it from the banking perspective. Okay, so the panelists today are coming at it from the tax perspective. But it really helped me, and it really enlightened the reporting that there were a lot of fights over this stuff. And I can tell you, as a newbie reporter, that when you get bankers and their clients fighting against each other without even regulators being involved, you've got a good story. So I'm grateful for the journalists who have continued to dig on this in Germany and in Denmark and in London and elsewhere. And the fact that we have an esteemed panel today who can talk about all aspects of this. It's not over. I now report on COVID-19 vaccines and cybersecurity, so I'm really especially honored to be here today. I'm going to explain the format. We're going to hear from 3 panelists. I'll introduce them in a moment. Then there will be a Q&A session. And all you need to do is look for the Q&A button at the bottom of your screen. You can do that at any time during the program. You don't have to wait. And in fact, we welcome you to do it earlier, because it might actually kind of help guide our conversation. But we have a lot to talk about, so I'm not the interesting one here. I'm going to introduce you to our speakers. They're all sought after by tax authorities, by government finance ministers for their expertise, and they're sought after by corporations and private clients. They've done a lot of amazing work. Let's start with Richard Collier, the author, the man of the hour, previously tax partner and global head of the PricewaterhouseCoopers PwC banking and capital markets practice. He's, as John said, an associate fellow at Oxford in the tax business program. He's done a lot of important advisory work elsewhere. I'm going to let him get into some of that. We have Professor Christoph Spengel from Mannheim University. He's a professor of international business taxation. He's an advisor to the German Finance Ministry and other governments. He's also taught at Oxford. I'm just going to say all of our panelists have taught at Oxford. It's a connective tissue here. And he's essentially in Germany renowned as a CumEx expert and beyond the borders of Germany, obviously. So Philip Baker QC comes to us from London, from Field Court Tax Chambers. He is an expert in international tax treaties, and double taxation, all of that very key to the CumEx trade. We're fortunate also in that Philip brings a crucial angle in that he's done a lot of human rights work, a lot of work on the impact of policy on human rights, including political refugees in the UK. And I personally am interested to hear about that, because that's not an angle I've heard a lot about with this. And we can't forget that there is a human angle here. So I'm just going to kick it on over to Richard. Congratulations on your book, Richard. Can you please explain to us how these trades worked? Because it's complicated.
Sure. If we had a lot of time, I'd be very happy to go through all of the detail, but that's not really possible. In terms of the way the trades are executed, you have complexity piled on complexity. You have trades within trades, trades simultaneously in different directions, and so on. So I'm going to limit myself by just pointing to some of the tax magic that arises, which is the foundation of the CumEx trade. Now, to do that, I'm just going to use 3, I hope, short slides, and they are all addressing the situation of somebody buying some shares immediately before what I call the dividend date. The dividend date is when the register of shareholders is inspected to see who is to get the dividend. And what I'm showing on all of my 3 slides is somebody buying shares just immediately before the check on the share register to see who gets the dividend. Now, it's probably as people will anticipate if you buy immediately before the dividend date, the key point is that you will be entitled to receive the dividend, but you won't be registered on the share register. So that's the background, these purchases immediately before the dividend date. Now I've put some numbers on my steps just for ease of explanation. This is a highly generic or simplified approach to the sort of the core of the magic in these trades. So if we look at step 1 on this trade, I've just shown a purchase of shares on the 25th of May, cum div. The buyer is buying with the entitlement to the dividend that is going to be paid shortly. And the buyer is paying €520. I'd just like you to assume that of the purchase price of €20, 20 relates to the forthcoming dividend. In other words, it's the compensation to the seller for not getting the dividend, or a reflection of the value of the dividend in the bundle of the share rights. So step 1 is buyer agrees to buy the shares with the entitlement to the dividend in them. You can see in step 2 that this is the parcel of shares that's going to pay a dividend. Now the point I want to illustrate here is because the sale is immediately before the dividend date, that means there is no time to register the new owner of the shares on the share register. But nonetheless, in most markets, share markets, the buyer would be recognized as entitled to the dividend. So how does this work? The buyer is basically paid out some money in the expectation it will receive the dividend, but the dividend is actually paid to the seller in this case, because there hasn't been enough time to put the buyer's name on the share register. You see the same issue when you buy cars and houses, there's always some delay. If you look at steps 3 and 4, this is what the settlement system does to compensate. The mission's got to be, if you think about it, the buyer is bought with the expectation of a dividend, but the shares have not been registered in time to move across to the buyer. So you would expect that given that the seller is recognized formally by the share register as the owner, what the settlement system will do will effectively take away that dividend from the seller and give it to the buyer. And indeed, that's exactly what I'm trying to present with my steps 3 and 4 on this slide. The settlement system is basically recognizing what's happened, i.e. the seller has sold shares already, but is still getting a dividend. And so step 3 is effectively taking away, reversing or debiting the seller. You can see at step 2, the seller would otherwise get a dividend. Step 3 is taking it away in the settlement system and effectively giving it at step 4 to the buyer. Fair enough. Let's see how this could be just slightly amended when we have withholding tax. So maybe if we can move to the next slide, we can just see what happens with withholding tax. Now here, the same basic situation. At step 1, the same agreement to buy the shares cum div immediately before the dividend date, meaning again, the seller is going to be the registered owner, even though it is the day before sold the shares to somebody else. So again, we need to make the adjustments in the settlement system. And so first step's the same. We have the dividend paid at step 2. But if you note here, what we have is, of course, the net dividend paid. And at step 3, you can see the withholding tax being taken off the dividend and paid over to the tax authorities. How then does the dividend adjustment system work in the clearance system? Well, as you might expect, the adjustment at steps 6 and 7 concern the net amount of the dividend, the 15 in my example. So step 6 is effectively taking away the dividend from the seller, the owner or the seller, and step 7 is giving it to the buyer. Then at step 8, the buyer is, if we stopped at step 8, the system wouldn't quite work because the buyer would have received the cash amount of the dividend, but wouldn't yet have received the tax credit, the entitlement to get a credit for the withholding tax. So what we see is that's adjusted for at step 8. The net effect of both of the first 2 slides I'm showing you is that exactly what we want to happen happens. In the first case, the first slide I showed you, the buyer actually is given the 20 cash proceeds of the dividend. That's where there's no withholding tax. In this second case, the buyer is effectively given 15%, the net amount of the dividend under the settlement system, and is also effectively given a tax credit. The tax credit at step 8, of course, represents the withholding tax taken off at step 3. Everything works out exactly as it should in these 2 examples. Now, if we go to my final slide, in fact, just before we do that, let me just make the point that, that in both these first 2 cases, we have an owner selling its shares. We have an owner selling shares that it owns. Now, if we think about the other situation that could happen is very common in share markets is that you have short sales. You sell things that you don't own. And so if instead of an owner sale, we have a short sale, which means that the seller doesn't actually own the shares, then we might think conceptually, how would that affect the dividend adjustment mechanism that I've been showing you at steps 6, 7, and 8? You might think that if the seller doesn't own the shares, we don't need the dividend adjustment mechanism, because the seller would not otherwise get the real dividend, because it's a short sale, and a short sale means that the seller doesn't own the shares itself. Let's have a look at what actually happens in my generic simplified model under the next slide. And what I'm showing here is pretty much the same thing at step 1. There's an agreement to purchase cum div immediately before the dividend date. You can see the parcel of shares then at step 2 is paying a dividend, but it's paying a dividend to a different person. It's paying it to a different person because the short seller is selling short, doesn't have the shares, so they go to another person. And you can see the withholding tax being taken off. However, what's then going on here is that settlement system is effectively assuming that the short seller is in the same position as the long seller, as the owner seller. So you can see that the adjustments or the steps at 6, 7, and 8 are exactly the same as they were in the previous diagram. In the previous diagram, that was appropriate because the seller was itself deriving the dividend. And it was deriving the dividend because there was not enough time, because it already owned the shares, and there was not enough time to re-register them in the name of the buyer. Now that takes us to the key difference here. In this case, the person receiving the dividend at step 2, who I've called a lender, receives the dividend, but there's no adjustment mechanism. This person might not even be aware of what the short seller and the buyer are doing, but nonetheless is able to lend the shares to the short seller to satisfy the sale. So normally when you have a sale like this, you might agree on one day, and then typically, which is my reference to T+2 at step 5 in this diagram, is when you deliver the shares. And here's another bit of magic in the tax system, that you can move the shares by way of a loan which I'm illustrating at step 4 on the 27th, so that the sale that's been entered into on the 25th can be delivered. But critically, what we're seeing is a loan of X dividend shares. This is why the trade is called cum-X. We're agreeing to sell cum, but we deliver X shares. I appreciate that for those people who are not familiar with settlement systems and the like, this is quite a lot to take on board. So maybe I can just stand back from it and show you that and make a couple of very brief points. Firstly, the settlement system operates for owner sales in the same way for short sales. Now, the reason that that is an anomaly is because if you think back to the earlier slides, what we have is the owner seller not getting the benefit of the dividend and the dividend adjustment mechanism giving it to somebody else. In this case, that's not true. In this case, the lender has the full benefit of the dividend. It's the lender who picks up the 15 of net dividend and is entitled to the 5 of tax credit. And if you look at steps 7 and 8, that result is also replicated in the hands of the buyer. The buyer also picks up the tax credit entitlement. Why does it do that? Answer: because the settlement system operates in the same way, basically assumes that the seller is selling its own shares, and so the dividend adjustment system is made. Now, that's probably a rather poor attempt at trying to bring out some of the magic that's at the very heart of the CumEx trade. As I've already mentioned, complexity in CumEx trades is piled on complexity. They end up being very, very complex aggregations of derivatives trades, stock lending, and so on. But what I've tried to do is just bring out a couple of points. And the essential one is really the duplication of the tax credit benefit at step 8. If the system can be stimulated to create this situation, then there is a clear tax benefit. The tax benefit is equal to the double or the incremental tax credit that is generated by the trade.
Richard, yeah, sorry.
Go ahead, Jen.
No, I mean, you brought up the point that the complexity was built in. I mean, the aim of these trades seem pretty straightforward, though, right? Is it an understatement to say, well, they obviously are complicated? You just explained why. I wish I'd had this tutorial when I was first trying to figure them out myself. But were they difficult to detect?
Yeah, I mean, complexity is a real problem. Actually, it's a real problem in writing the book because these things are impenetrable in many senses. In the book, I use about 30 different diagrams to illustrate how the complexity builds up. I think there's one sense in which it's fair to say that you have to know everything about CumEx trades before you can know anything. And what I mean by that is that it doesn't really help you to understand the individual components of CumEx trades. It doesn't really help you to understand what a stock loan is or a short sale or a futures or a forwards trade. You've got to understand how the whole thing fits together. And to do that, you really need to know a lot about tax rules, of course, but you need to know a great deal about settlement systems, market conventions, trading system features, and of course, all about different financial products, and so on. So there is an enormous amount of complexity in these trades. I've already mentioned that you'd often see trades going both ways between one party and another. It'd be trading in different directions, or there'd be trades within trades. So the problem is really acute. In the book, one of the things I do is compare CumEx to Dieselgate, the Volkswagen Dieselgate case, which involved emissions control. And it's no coincidence that in that case too, that the misconduct was located at the heart of the most complex or abstract part of the product. And in the VW case, it was where multiple vehicle management software systems and literally millions of lines of code converge to achieve an operational outcome, namely the testing of vehicle emissions. And I guess the point that I'm keen to make is that in a tangible product like a car, that's quite exceptional to have that level of complexity. But in the financial sector, you could, if you wanted to go to the extreme, take the view that here in the financial sector, we've got an abstract, intangible, impenetrable, and closed system. You could describe it as one enormous emissions control system, potentially available to be configured, reconfigured, and operated to defeat its purpose.
Richard,
so yes, complexity is a huge issue.
Thank you for that. Who is to blame? I mean, this is something I'd like all of our panelists to address because I think it's it's still one of the very robust arguments around these trades. And, you know, the complexity, in your opinion, who's to blame for the outcome of these trades and the cost to the system?
Yeah, well, I know the conventional answer, and this is something that I do investigate in some detail in the book. The conventional way that cum-ex and many other financial misconduct cases are dealt with is on what I call in the book a bad apples theory. Namely, it is the few bad apples, in this case, the cum-ex traders who really caused all the problems and are to blame. Now, I'm not saying that's wrong. I'm just saying, but I'm certainly saying that's an inadequate view. I'm not convinced of it. It may make for great shock and outrage stories, but I think there are a number of reasons why it's, I think, completely inadequate, basically. And they are, for example, it doesn't explain why hundreds of banks and at least 1,000 individuals within banks were able to carry out the trade for years. It doesn't explain the causes. It doesn't explain the regular recurrence of issues within banks and tax systems, nor, as I say, the very large number of individuals and institutions involved. And it's not an isolated case. And another case I look at in the book is Wells Fargo. And I just checked this afternoon, 5,300 individuals were fired for fraudulent sales practices in the Wells Fargo case. The bad apples theory doesn't explain either the opportunity set, the raw material that's open to explanation. And it certainly doesn't explain what's going on with tax systems, the way that tax systems create rights like tax credits or tax reclaims, which are typically available by tax systems to be available to some taxpayers, but not others. Yet with the ability to control or police that on the part of the tax authorities, sometimes absent or easily circumvented by financial product planning, sometimes of the most basic sort. So I ended up being pretty skeptical about the bad apples theory as a complete explanation of what's going on with cum-ex.
I mean, it doesn't seem like they're mutually exclusive, right? I mean, both can fit together.
That's right. I do think there's a more plausible and useful explanation. Basically, the book was written to try and explore why do you get serial misconduct in the financial sector, and my answer is not because of the bad apples.
Okay,
but it's not really the answer.
And one more question for you, Richard, before we move on to Christoph. Sure. Is you've devoted so much time to this topic. I salute the obsession and the ability to just keep focused on this for so long. What are some of the more important policy lessons that you've learned in looking at this for how many years?
Well, 2 years, struggling with the German. So I'm going to mention three lessons I think are really important, or seem to me important. And that is firstly that I don't think cum-ex is, well, I know cum-ex is not an isolated case. There are plenty of other examples, and I certainly came across a few in researching the book. The point of general relevance I'm making to start with is that weaknesses in the system, like the one illustrated in cum-ex, will certainly be industrialized. In cum-ex, we saw global participation, hundreds of banks and funds and so on, and billions of euros at stake. And in the current system, this is and will continue to be inevitable. The second point I'd make is that I have some feeling for the tax authorities. I think they're in an almost impossible position. But I think they routinely underestimate what's required to police the system that's been created. And the supreme irony of that in the cum-ex case for me was the discussion in the OECD intermediaries document, which lauded the German tax authorities for their very close cooperation and knowledge of what was going on in the banking sector at the very height of the cum-ex affair, which I thought said it all. And then my last comment of what an appropriate lesson might be is the most fundamental. Do not create a system you cannot operate and police. Or put another way, do not create a system whose complexity is better managed, and that means including being monetized by a set of people who are not those charged with administering.
Great. Thank you so much. All right. Well, that's a raucous start. All right. Christoph from Mannheim. Vielen Dank for joining us today.
Yes, thanks for inviting me. And I would like to tell you something what's going on in Germany up until now, because Germany was hit mostly by these transactions. Could you just move the page, please? So Cum-Ex in the news, Richard has explained it with a very simple example. And I can confirm that around 130 banks are involved, and the prosecutor investigates currently in 70 cases, and there are more than 900 suspected. But not only banks are involved, as you can see from my examples in leading German newspapers. We have also family offices, funds. The offices of Freshfields were searched twice by the prosecutor, and the global head of taxes has been imprisoned in Germany for a while. And we found also professors who wrote legal opinions where they just put their name on, and the role of banks was manifold. They could act as short sellers, as short buyers. Typically, these transactions were leveraged by high capital, and the role of banks was various, and also others were involved, like bankers, brokers, lawyers who set up the models, who wrote the legal opinions. And I got official data from the German stock exchange, which was highly aggregated, and we come up with a minimum tax damage for a short period of about 7 billion euro. Could we see the next page, please? So in addition, I show you this. This was an official client information from BNP Paribas from 2008, that you see how much lobbyism was involved also in the lawmaking in these hot days. So I just read it because we all should read that. Full details together with Deutsche Bank, okay, Citibank, Clearstream, that's a subsidiary of the German stock exchange who is responsible for the settlement of the trades. And some other banks organized a meeting with tax representatives of the Federal Association of German Banks. The main question of this was, who is bound to deduct withholding tax on short sales? And the question is relevant because Richard has explained that very clearly, but you can believe me, neither the short seller nor the buyer, was in Germany. That was, the buyers were often US pension funds, and the short sellers were mostly located in the UK. And so it was really not possible to detect these schemes very easily. And who is bound to deduct the withholding tax on short sales? Because actually there was never a deduction of withholding tax on the short sales. And the Federal Association of German Banks, and mention it here, was the initiator of a particular part in question of a Tax Amendment Act, which was very relevant in 2007. As a result of this meeting, okay, we can record that the obligation to withhold tax on short sales only affects German banks selling securities. Therefore, non-German financial institutions, okay, located, for instance, in the UK, like Barclays, and their German sub-custodians were not liable to monitor and withhold tax. This means our interpretation of the Tax Act was confirmed, and by the initiators of the particular part of these acts. They also confirmed that the understanding was the common understanding of the whole legislative process. Actually, someone who was paid by the German Association of Banks drafted this relevant tax law. Could we see the next page, please? So we have already 3 judgments of a lower German tax court, and they clearly pointed out that Cum-Ex violates the tax law, and it is a criminal masterpiece because everybody involved knew each other. And you see the tax damages here, and if I say final, that means the persons, the defendants, they did not took the opportunity to have an appeal at the federal German tax court. We will have now a final decision because the last case is pending. And if I say, okay, the tax damage is 120 million, 25 million in one case, that's the dividend withholding tax. So you can believe me that the volume of the traded shares in one transaction, in one Cum-Ex deal, was more than 10 billion euro. Okay, and if there would have been a damage, okay, that would have been destroyed the whole system. Could we see the next slide, please? So we have now, as a fact, from March this year, a decision of the Bonn Regional Court that Cum-Ex transactions are criminal. They are not only against the law, they are criminal. And we wait for the final decision of the Federal High Court of Justice. So in this single case, that's 1 out of 7 cases, okay, 70 cases, the tax damage was estimated at 440 million euro, and we had 2 defendants, British stock market traders, out of 900 suspected, and 5 banks were consulted to the case. So there is a reclaim to a private bank, Warburg in Hamburg, of 160 million. And as I mentioned, the Cologne prosecutor investigates several cases, and I know the files of the inquiry, and they cover some 23,000 pages. And we have opened additional criminal cases at other regional courts, and there are bankers involved and tax lawyers in Bonn, Frankfurt, and Wiesbaden. Could we have the next page, please? So as Richard has shown, before the Cum-Ex transactions took place in Germany, someone has, delivered or landed the shares into Germany, because only 1/3 of the German listed shares belong to German shareholders. That means 2/3 are abroad. And first we have to bring them in, and that is always cum dividend, okay? And we have cum transactions in the news, and they affect some 77 banks in Germany, which have revealed that they face a tax risks. And I just want to point your attention on the top, on the left-hand side. There was an investigative network with ProPublica and some German institutions, and they discovered, say, from one US bank that was leaked, that there was a tax damage for 3 years for 1 billion euro each years. And as you can see, there are banks affected, public German banks, Landesbank Baden-Württemberg, and also other, the Swedish banks. You see Goldman Sachs, and I can tell you the former president of Goldman Sachs is acting secretary of the state in the Federal Ministry of Finance. And the estimated tax damage is enormous. So we come up numbers by some 50 billion euro. And it is clear that also these transactions violate the tax law. There are 2 judgments, one by the Federal German Tax Court and one by the Lower Hesse Tax Court. And I can tell you nothing happens so far in Germany. Could we see the next slide, please? As also Richard mentions in his nice book, okay, we have a European problem. And you mentioned that, Jenny, that not only Germany was affected, but it was affected mostly, that the overall tax damage could be some 55 billion euro. And we also face what I call cum fake transactions, that we revealed a 300 million tax refund on non-existing American depository receipts, on non-resisting. That's simply fake. And finally, I would like to draw your attention on common action by the European Parliament. After I had a hearing there was a resolution about financial crime and loopholes in the current legal framework. And the most important point in this resolution is that we need a European prosecutor and a European tax police. Thanks for attending my few words. And
I have a couple questions for you, Christoph. Thank you. So this was more about the bad apple side of things, which is a good counterpoint to Richard's. I mean, it's interesting, you know, I remember reporting on this in like 2013, 2014, and it didn't seem to kind of register that much. It wasn't like, there were a few investigations going on, but it seems like such a long and winding legal road. Do you have a view on why this is taking so long to get through the legal system and just sort of the politics around it in Germany? If you could give us that view, that'd be really helpful.
So first, I would say that the politicians and who is responsible for this is the German Minister of Finance, because he's the boss of the tax administration. He's the boss of the tax office refunding the tax. He's the boss of the tax offices collecting taxes, and he's also the boss of BaFin. That's the institution who is responsible to control the capital market. And nothing happened. And you have to see, different from the UK, we have a federal country, and tax is collected by local tax offices from the lender, and the refund of taxes is organized by a federal tax office. And obviously, up until now, both offices, okay, are not linked in the area of digitalization. So to be very honest, the Minister of Finance and no one in Germany knows how much withholding tax has been collected by the lender
at the state level.
At the state level, and how much taxes have been refunded at the federal level.
Yeah. Okay.
So he is responsible. And then I have to be also honest in a way that these structures were very complex, okay, and they hide information, okay. It's, you know, you don't get the whole story. And therefore, these transactions are criminal, because in the end, who is responsible? That's the short buyer handing in a wrong tax voucher. And if the short buyer or someone who wants to get a refund or a reclaim of tax doesn't disclose the whole structure, okay, then this is criminal. And as I mentioned, there are two defendants now and they are also defendants in the Wiesbaden case, that the two British brokers, okay, and they really disclosed so many informations to the prosecutor, okay, not only emails, you have chats, okay, WhatsApp and SMS and what you can think of, and that enabled the prosecutor, okay, to reveal, you know, the whole structure. Who was the lender? Who was the borrower? Right? Because
they're not supposed to be arranging trades by text. I mean, that's you know, that's not how it's supposed to happen, right? So that you needed that kind of disclosure from a defendant to help with the case.
Yeah,
right?
Obviously.
Yeah. Do you, Christoph, I mean, you're an expert in international tax. I mean, what implications are there for Germany's tax system coming out of this? I mean, is there reform? Is there?
I can tell you there has been a reform in 2012, and everybody, and including me, believed that the CumEx has been stopped technically, because up until 2011, the corporations paying the dividends had to collect the withholding tax, and the custodian banks of the owners, the shareholders, they issued a tax voucher, okay? And there was some mismatch. And since 2012, not the corporations withhold the tax, the custodian banks withhold the tax, and only someone who has withheld the tax may issue a tax voucher.
So
But
they
I
can
can
match
tell
it
you-
up. They're supposed to match them
Yeah,
up.
but
Yeah.
it hasn't stopped. It hasn't stopped. We just had a public hearing in the German parliament in September, and here it came out that that it still happens. And we had, we had in August what we had in Germany, that banks were searched by the prosecutor, and the case happened in 2016.
Yeah.
And if I were responsible for this, okay, in the area of digitalization, it is obviously possible, okay, to match every dividend payment and the withholding tax with a tax voucher. You can mark that.
Yeah.
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 So
Okay.
it's, in my view, it's really it's a great failure, you know, in the whole system, in the political system, and it's impossible for me that the former boss of Goldman Sachs, okay, is Secretary of the State, acting secretary in our Ministry of Finance.
Okay. Well, that's certain to fire up some people. So, Philip, back to the UK here. All right. We have QC. Away with your slides, or take it away with your slides here.
Thanks, Jenny. Let me start by saying that I have absolutely no reservations in saying that this is a book which, frankly, every tax student and every tax lawyer should read. And the same goes for financial journalists who have any interest in tax or banking. I'm actually inclined to say that if you only ever read one book on tax, this is it. But please, students, don't quote that back to me. That's not because Richard is an old friend, but because there are two excellent parts to this book. In the first part, as Richard has just done, he explains with tremendous clarity how Cum-Ex worked and how they were structured and how they developed and grew. I'm really interested in the second part of the book, where he looks behind that at the underlying causes of how Cum-Ex trades came about. What were the failures in the system that allowed these trades to develop? And Richard focuses in particular on two failures. Firstly, failures within the banks of adequate supervision and failures of the banking regulation regimes. And then secondly, failure within the tax authorities, failure to understand the banks and their trading strategies, failure to recognize and correct defects in the tax system. If we could take the next slide, I've put on that the start of the concluding part of Richard's book, and he says this book is a study of failure. It might be argued that the failure lies in the inability of the banks to control their traders and front office staff, or alternatively, that the source of failure is that of the regulators and tax authorities in being unable to control the banks. However, each of these interpretations is an inadequate explanation of the nature of the problem and underestimates the scale of the much more pervasive failure at all levels of the system. Turn to the next part, next slide. As is demonstrated by the case study, the conventional mechanisms of regulatory control, as exercised by the regulators and tax authorities, were either ineffective or broke down completely. The regulatory authorities seemed barely aware of what was going on. As to the tax authorities, the actions of the tax authorities were no less of a failure, both with regard to the time that it took them to realize the scale and the failed attempts to close the trades down. Next slide. Based on the discussion in part 2, it's concluded that this failure cannot be regarded as some sort of isolated aberration, but is rather the practically inevitable consequence of the operation of the system as a whole. From the perspective of banks, the failure of the system is not just a feature of the system, but rather the foundation of the entire business model. And if I may, I'd like to go a little bit further than Richard and focus on some of that elements of the underlying business model, I'm particularly interested in some of the failures, including individual failures, that led to the development of these trades. Richard discusses the role of the capital market groups that existed within banks, which consisted of individuals whose basic work was to develop these trades. He also discusses the role of the lawyers in some of the world's most reputable law firms, without whose opinions none of these steps would have been taken. How could these people not have realized what they were doing? To my mind, the CumEx trades are like finding a broken vending machine, that when you put in your coin, you receive your bar of chocolate, but the machine then gives you the coin back. So you can put the coin in again and get another bar of chocolate, and again and again. And the only limit is the amount of chocolate in the machine. Very soon you realize, if you're doing this, that the owner of the machine didn't intend you to deprive them of all their goods without payment. Now, for those who were working in the capital market groups in the bank, they must have understood exactly what they were doing, but they didn't care. They were making money for their banks, and they were earning high bonuses. As to the lawyers who provided supporting opinions, no doubt in some cases, they will not have seen the full picture. They will have been asked to opine on a specific issue like, is X the beneficial owner of the dividends? But I don't see how they could possibly have opined on one aspect without asking to understand the wider transaction. Now, there comes a point in every tax lawyer's or tax professional's life when you are asked to consider a structured transaction or some other aggressive tax planning, and your stomach simply turns. How could those who devised this structure think that it was anything other than sophisticated theft? For me, that occurred in the early 2000s when HMRC began to consult me about various structured finance products to see whether they worked, if they should challenge them, or if they could change the law. And as I recall, in every one of those cases where HMRC challenged the bank ultimately conceded that the scheme simply didn't work. It's quite fascinating to see how many tax academics, particularly those interested in corporate social responsibility and tax, started life as tax practitioners. But when you ask them why they turned from tax practice to academia, very often they respond by saying, I began working in a major law firm in New York or London or Frankfurt, but I was asked to work on opinions on structured finance transactions, and that was it for me. Underlying the problem for lawyers who are asked to give opinions to support these schemes is the idea that tax has no moral dimension. It's all about black letter law. That is total rubbish. Tax has a fundamental moral dimension. It's how we fund society. To quote the often quoted statement of Oliver Wendell Holmes, taxation is the price we pay for civilization. That doesn't mean to say that tax law is irrelevant and the tax authorities can ignore the law if they wish, but deliberately manipulating gaps in the law or difference between legal systems to ensure that the chocolate machine keeps on vending the chocolate without the money is not the role any person should be playing ethically. So Jenny, Richard's book forces us to ask ourselves some of these very important questions. That's why every tax practitioner should read it. It also points out very clearly what the answers ought to be. Thanks very much.
Thank you. That was very fascinating. And I think we have a good dimensional panel here. So Philip, can I ask you, do you think this discussion will change anything? I mean, what you're talking about, the culpability of the opinion letter writers and the bankers and the tax authorities, is anything going to change, or has it already?
I think it's changed in the sense that the people who are doing some of this work have moved from the banks, and they're now in private equity funds and they're in boutique firms.
Mhm.
But are these trades or other forms of trades, whether they are other types of tax shelters or tax credit generators or other forms, they are going on as well. Maybe if some people go to prison, then things will slightly change. But and no doubt Richard is absolutely right. The regulators need to learn lessons. The tax authorities badly need to learn lessons. But there is also the individual side. There were people who were implementing these, coming up with the ideas, giving opinions. And those people need in the future to think very, very hard whether they should be doing that.
So I want to ask you, just because you have done work in the civil rights realm related to tax policy, and I remember when I was writing about this, there were people who would write me angry emails saying that I was, against banks and capital markets, and I didn't understand derivatives, and this was a victimless crime, and I should move on. Your view?
Well, in terms of tax and human rights, that's a crucial area for tax lawyers to understand. Tax lawyers have a very real role to play in ensuring that the rights of taxpayers are protected. I mean, if you take key human rights cases like Ferrazzini in Italy, or I refer to it as Fettuccini in Italy, that's a case that lawyers need to consider the importance of the right to a fair trial. So there are rules that tax lawyers have to make. You call it civil rights movement, we call it human rights over here. Yes, it's quite critical that one should recall those traditional roles and not simply be involved in providing opinions that service these schemes.
I mean, just when you look at Christoph's slides and the numbers involved, and you look at kind of, I mean, I know that pension funds made some money, right, doing the stock loan. I mean, pension funds were the big sources of the securities being lent. But as someone, how do you think that, as the inventor of these products, how do you think that the tax auditor or the formal compliance process can actually ensure that tax law is being adhered to?
That's probably more Richard's question. I'm not the inventor of these schemes, but Richard's probably got some very, very good ideas about how the tax administrations should be improving their regulation. One of the important things is that they understand how the banks and now the private equity funds and others, how they operate. We don't have a good system in the UK of in and out, where people go into commercial firms and then back into the revenue. You tend to be in the revenue and then move out.
Yeah.
And clearly, it's much more important that there's a closer understanding there, and to start spotting, early warning systems.
Mm-hmm.
It's very obvious in some of these cases that there were tremendous increase in trades around dividend days. Somebody should have picked that up. And I remember looking at that for HMRC 15 years ago. And it was clear that certain transactions were going on around dividend dates that were in some way being tax driven there. Jenny, can I take an opportunity just to answer one point? In the question and answer, someone's asked me about any comments with regards to Denmark and the SCAT pension there. I want to make it very clear, I am not speaking at all about that. We are talking today only about the German cum-ex matters. I'm conflicted on the Denmark matter. And I want to make very clear that nothing I'm saying in any way relates to the Denmark situation.
I think Christoph might want to weigh in on that.
Yeah.
I would make 2 points. There was no inventor of this scheme, because it came up from the investigations of the prosecutors that there were investment bankers from Morgan and Stanley in the late 90s, and they settled a transaction long. However, they were not in a position to get the shares early enough, and it went into a short sale. And the system in Germany produced 2 tax vouchers, okay? And so it started. And of course, you know, these are very intelligent people. They know the capital markets and so on, and they did all the trades over the counter, so very anonymously. And Philip, I'm not so sure about the involvement of tax lawyers. I have seen many opinions, okay? And I have to stress that the global head of taxes of Freshfields has been present in Germany, okay? Because they offered full schemes, and I saw opinions, okay, written, and it was clear, it was named short sale, and they gave an opinion that there is an entitlement to credit a withholding tax on a short sale. And I can tell you something about the Danish case, because I know it very well, because it happened also in Germany that this person now being in Dubai, Anshu Shah, that he has established more than 140 pension funds, and 20 or 25 of them used the German bank in Mainz as a custodian bank, and I know all about the rate and the transactions. And in a sense, it's also in Denmark, it has been a technical problem that tax vouchers were automatically issued by SCAT, and they were even emailed, okay, to a person, a pension fund, signaling an open buy position, okay? And so it's technical, it has always been against the law. And I also know that, okay, the reclaim agents, that they were maybe Barclays, okay? And it was organized, say, in the same manner. And what I also know from the prosecutors in Denmark and in Germany, that identical persons, US citizens, were involved in the cases. And so therefore, the German tax court said it's a criminal masterpiece because they detected the whole case. And of course, you know, there was a question in the chat that the seller and the buyer cannot know each other. You know, it's not a one share deal. If someone sells 348,000 Daimler shares, there must be exactly one person buying this number of shares. Otherwise, the system would have not been functioned. And therefore, it's a masterpiece, criminal. And criminal is illegal.
By you're talking by masterpiece, you seem to be saying essentially collusion rather than just coincidence, right?
Right. That was set up from scratch.
Okay.
Jenny, can I just come back on Christoph do things? I just want to be clear, Christoph. I am commenting not at all myself on the Denmark situation for conflict reasons. But as to the law firms, I think you and I are completely ad idem on this, on the opinions that were being given to support these trades. Steps would not have been taken in these trades if they were not approved by the lawyers at every stage. And that's the ethical question that I think people need to read this book for and need to ask themselves those questions.
Richard, maybe if I could ask you a question from the queue. We're just going to go into the Q&A now, if that's okay, like purely. We've already kind of gotten into there anyway, but which we have a lot of questions, which is great. Have banks cleaned the decks on this? You know, are they actually, have they cleaned up shop on these trades and trades like them? And also, what do you think is the next Cum-Ex scandal? Because there's always a next one. Richard?
Both of those questions are quite hard to answer, I find. I mean,
Sorry.
I mean, during the course of this call, I think you've heard both Philip and Christoph comment on other cases that they're seeing. And the whole thrust of the book is that this is inevitable.
Yeah.
This kind of abuse is inevitable. And I've already made it clear that while I think the whole bad apples analysis, and I'm not saying that's wrong or inappropriate, I'm much more interested in the need for systemic change, to take much more seriously the systemic factors that are causing all this. So I guess, obviously, if you ask me, do I still think this is going on? You're asking me, do I still think that whole analysis is relevant? Well, I'd say, of course it is. That's really one of the reasons why I thought it was important to address some of these issues, as Philip says.
Somebody just commented, it's not bad apples, it's bad orchards. So, so here's a question. How challenging is it? This is a rather technical one. How challenging is it to sidestep the settlement process for short sellers to go around this anomaly? So I guess the question would be, can you head fake the system? I don't know if they mean now or in the past, but the settlement process was pretty gameable before the rules were enforced, right? I mean, that's kind of what shut down Cum-Ex was Clearstream said, we're going to enforce the settlement rules, right? And you can't game it anymore.
Yeah, I mean, broadly now, you're subject to the point that Christoph's made. Broadly now, the position is completely changed. It's probably worth emphasizing that the settlement anomaly that we're talking about, and really that's what this is. It's essentially all about a settlement anomaly. And Philip's analogy of the vending machine is absolutely on point. It's something that can be stimulated. By the way, it's much more complex and much more difficult to stimulate this than putting a coin in a machine, but the metaphor is absolutely right. It's something that can be stimulated. And that is where the inevitability arises. Now that as a general matter, the situation, the ability to stimulate is actually, when you work through the analysis, applies in very, very narrow circumstances. You've got to be very close to a dividend date and you've got to have a willing buyer on the other side. What is relevant, it seems to me, about the Cum-Ex case, indeed in most of these cases, is the way that this whole process is industrialized. Mm-hmm. And it's the process of industrialization that I think is particularly significant and remarkable.
Yeah, I mean, in London, we used to hear about brokers and traders meeting up at Carluccio's like early in the season to just like agree on their stock loans and get it all done. And then they basically like didn't have to work that hard the rest of the year. I think one of our audience members will find that familiar. Jenny, go ahead, Christoph, please. Jump in.
Also, Clearstream has been searched twice by the prosecutor. So that's, you see, because there's also a question in the chat, would that be something for BEPS? No, it wouldn't be something for BEPS, because, you know, if you smuggle drugs, okay, you don't disclose the scheme. That's the point. But we should really ask why it happened in some countries and not in other countries. And it's a technical issue. And I can tell you from my experience, for instance, in Spain, it is never possible in Spain that you get 2 tax vouchers, okay? And I would stress, we are in a digital age, okay? And you can really mark, you know, each dividend payment with a tax voucher. You can use a blockchain technology or something like that. And another aspect, why we don't detect these schemes very hard in Germany. Think about the financial crisis, okay? More than 10 years ago, we put 65 billion euro in the financial sector in Germany. And look at the banks who are suspected. Take Commerzbank, okay? It's now a partly public bank. And so this is it's a whole mess in my opinion. But my finding is, you know, I'm no practitioner. You know, I'm a professor. I've always been at academia. What I found out, what is really criminal in these investigations in the last 5 years. It's unbelievable.
I have a question for anybody who wants to answer. I mean, I remember early on writing about this, and then I covered Deutsche Bank for several years. So I spent a lot of time in Germany, and there was always this kind of whisper, idea, and I know this has been in the German media, that the government looked the other way during the financial crisis, looked the other way on Cum-Ex, because it was just a little way to help the country's banks, to let them do these trades, without actually like calling it a bailout or a direct benefit, to let them sort of make a few 100 million during dividend season during a tough time. I know Richard has a view on this because we've talked about it, but
yeah, well, I think that's just the craziest thing I've ever heard.
well, I've heard it from a lot of German bankers. So
yeah, but the idea that the German government, I mean, Christoph should speak on this, of course, but the idea that the German government would understand this with such sort of penetrating insight to understand exactly what was going on is completely contrary.
But isn't there evidence of this being discussed like back during 2008 and 2009?
There's some, well, I should leave Christoph to speak on this. There's early discussion, but no one understood the scale of this.
Okay.
I don't. Christoph, tell me what you think.
No, Richard, you're absolutely right. Okay, that was, there was no clear legal view on these transactions. So the first case is covered by the tax administrations. The first case was in 2010. Okay, there they stopped it. Okay, and changed, the tax declaration. And then there was a lot of, literature by tax practitioners, by tax professors. They have all been paid. Okay, that came up from the prosecutor, and they said, well, there could be at the dividend record day, there could be two owners of a share, the legal owner and the economic owner. That's completely nonsense, okay? And so it was very, unclear. And the politicians, since what I tell you, they had no clue about the tax damage, because up until now, if you ask Mr. Scholz, our Minister of Finance, how much tax do you collect from the withholding tax, and what is the amount of the refund? There is no information. And that's sad. And telling you about Deutsche Bank, it has been involved in all three cases in the Hesse tax court. And well, you know it better than me that there is no scandal where Deutsche Bank is not involved. And what makes it so difficult? This is money for the German population at a magnitude which is unbelievable. And Philip mentioned it, and Richard mentioned it, Dieselgate. With Dieselgate, everybody who drives a diesel knows he's affected, okay? And there is, there is noise in the public, but tax issues are so hard, to explain to people.
Right. Yeah. So what about, there's a good question in the queue about, so the fiscal costs are pretty evident, and you've all laid that out very clear, they're stunning numbers, but what about the cost and the damage of these transactions to the financial system itself? I mean, it would seem to, trades are supposed to have an economic purpose, right? They're not supposed to be solely focused on gaming the tax system. Is this market manipulation?
Okay, so I'm going to go first on that one. I think it would be helpful to be a market manipulation expert, which I'm certainly not.
I know. Sorry, I'm going back to the banker side of it. Sorry.
Quite hard. But I mean, there certainly there were concerns in the German market about systemic stability caused by, and Christoph, correct me if I'm wrong, but I think there were at least 2 sweeps by the German tax authorities of surveys of banks. The Maple Bank actually was basically wiped out, and some very significant losses were created. There's been massive litigation on this, about investors putting their money in funds, suing on lack of performance, and so on and so on. So there's been a huge set of dislocational issues, and there have been concerns about systemic stability. Quite how far they've gone in the German market, I don't know. I mean, a number of people listening to this will be aware that the Financial Conduct Authority announced they were investigating 14 firms, I think just 4 or 5 days ago. So the whole regulatory side of this is obviously raises an important set of issues, but probably with 3 tax guys on the panel, we might be struggling to give a deep insight into that.
There's a question. Go ahead, Christoph, please.
Well, if you mean by market manipulation, if there was a manipulation of stock prices, no. Because you know, there was no risk in the transactions, so there were always long and short futures in order to exclude
flat
risk, because
risk.
Take the enormous amounts of shares and the value. Soon after, you know, the buyer handed in the tax voucher, or even before, they resettled all the transactions.
Yeah.
Okay, so that took 3 or 4 days. Okay,
yeah.
For, you know, and the Danish case was all circular. It was all circular. Nothing happened. No real transactions. So there is no manipulation in the share prices.
This is a really good question, actually, for all of you. Do you think there's a key point or a couple of key points along the way when authorities could have stepped in, like crucial moments that opportunities missed? And when you look at the timeline of the development and the evolution of these trades and the damage done. One of our viewers is asking that.
Well, I'm hesitating in case Philip or Christoph want to take this. To me, it's the wrong question. I mean, to me, the issue is that the problem is that the specialist understanding within a tax authority, I mean, certainly from my own experience in the UK, I've worked with a number of tax officials. Some have got really fantastic understanding and insight on the market, but as a general matter, so leaving aside those really superb exceptions, as a general matter, tax authorities struggle with specialist knowledge, and they struggle with deep understanding about the way the market works. And I think they continually struggle with understanding the scale of possibility of exploitation, this industrialization point. So asking if there was a point where they could have asked a question is kind of, for me, it's not quite the right question, because there's a real competence issue. And I don't mean that to sound patronizing, but there's a sort of real specialist understanding competence issue that is completely missing. And that makes the question, to me, quite an awkward, you know, potentially irrelevant question. The reality was the scale of what was at stake was never appreciated. I think, Christoph, I'm right in thinking that there was early evidence of this issue emerging, I think, in the German parliamentary report, charts it going back well into the 90s. These sort of issues arose then. And, you know, if you presented them to somebody who spent a lot of time in capital markets, tax structuring, then it's going to take you 10 minutes before they're turned into a financial product. But the German tax authorities just didn't realize that. I think that's the issue.
Yep, they got the German Association of Banks wrote a letter in 2002 to the Minister of Finance. This letter is public, and they mentioned that there is a problem with Cum-Ex short sales with regard to the refund of the withholding tax. And in this letter, it was also mentioned that a tax is never withheld if the short seller is located abroad. So this information is almost 20 years old. And another thing I can tell you about cum-cum transactions, if I know publicly that in 2015, Commerzbank holds more than 10% of the share capital of Siemens, why do I don't start action? Okay, what is this? This is nonsense, okay, that a bank holds 10%, more than 10% of the shares of Siemens at the date of dividend resolution. You know, what's behind this? And therefore I said there is no activity in Germany from official activity. I have on my slides, I have banks, you don't know them, Sparkasse Bodensee, that's Lac de Constance, yeah, a small bank, and they had to refund 36 million euro of withholding tax. So you see the whole dimension of this system. That's crazy.
Yeah, it is remarkable that the tiniest Sparkassen were involved as well. You know, it shows the systemic nature of it. Philip, you were about to say something, I think.
Only to say that it is also something that's puzzled me as to why this was not picked up earlier, because the increase in the withholding tax repayment claims ought to have triggered off an inquiry. Similarly, the trading over dividend days, you would have thought that somebody would have picked that up. So I just find it puzzling as well. The only comment that perhaps one would make is that in the UK, the introduction of the system of disclosure of tax avoidance schemes, DOTAS, did shorten the period of time between which a scheme was devised and the revenue authorities learnt about it. In the case of banks, my recollection from the early 2000s was that some of the major banks in the UK used to meet with the revenue probably once a year and describe the trades that they had been engaged in. And that would be the time at which the revenue really first learned about what some of these products were. And then they'd have to sort of work out whether they worked or not and whether they'd have to counter them. Whether there is, as a lesson from all of this, a greater extension of disclosure obligations on those really internally generating these schemes, that's an interesting question as to whether that's a way of dealing with it going forward. I don't know. I can't recall actually whether, Richard, you discussed that.
I think I mentioned that briefly. It's probably one of a number of things. I don't think that in terms of things like disclosure or transparency options, they're not going to work by themselves, I don't think. I think there's an underlying systemic problem, personally. And so these measures are probably going to be helpful, but they're not going to deal with the heart of the problem, which is very, very difficult. I mean, I'm not pretending it's an easy issue.
So one of our attendees asks, does the problem go away if you don't have withholding tax on dividends? It might have more fundamental ramifications for the tax system, but the losses are such that it might need to be addressed in a more fundamental way.
It shifts somewhere else. Somebody else in the question and answers has said, you've got a similar problem with VAT repayment claims. Except in the case of VAT, we often call it MTIC fraud. It just shifts. That's why, in part, my interest is on the ethical issues of the people who are actually involved in making up these schemes and in providing the legal opinions. If you don't have those, if those people have a sense of their moral responsibility, then you don't just shift from one target to another. Others may have different views.
Well, I mean, Philip, I don't disagree with what you're saying. Certainly, I would agree with the comment raised by that question, Jenny. Withholding tax would be one of the first things on my list of obviously, I was just about to say dumb things, but I better not say that. That sounds too
gameable, manipulate.
Yeah, it's one obvious area that creates a lot of problems. So in other words, if I have, if I own an asset and I get one tax benefit on it, and Philip owns the same asset but doesn't get the same tax benefit, which is the way withholding works, it raises a lot of questions like, can the system control the access of the tax benefit to me and not to Philip?
Yeah.
What about the incidence of tax? The fact that it is available to me, the market value, what that means is that the market value of Philip's asset will go up, recognizing that other than in Philip's hands, the asset might have value. That incentivizes him to trade it. And of course, what we're dealing with here is fungible trading products. So I think there are a number of aspects why withholding tax might be thought about, namely to do with the lack of control of isolating tax benefits, which is otherwise assumed by the tax system, incidence issues which encourage cashing in, monetizing the tax benefit by those who are not entitled. And then we've got all those other issues about the ease with which that can be done under modern financial systems using derivatives and so on.
I think we have time for one more question, if that's okay, and then to say thank you to everyone. So I'm going to roll two questions into one. What are your expectations? And I know this calls for speculation, but I think enough people have asked this that it's worth asking, of the ultimate outcome of the legal cases in Germany. Sanctions, imprisonment, you know, will banks truly be hobbled as this rolls forward, as these cases progress? Like, how bad is it going to get?
I would say very severe for the defendants. I talked to a lot of judges. They have a clear opinion, and you know, the cases at hand are 100% clear for the courts. Okay, the prosecutor has done a great job. His list 23,000 pages, and that's that you cannot believe the information they have. So they were able, you know, to reconstruct the cases, who was involved. Yeah, and if they say it's criminal, okay, you can be imprisoned up to 10 years, okay. And my belief is that the courts, the judges, that they will be hard, because they are not joking anymore. And
I mean, that's going to be interesting, because in most countries you don't see a lot of people go to prison for financial fraud, right? I mean, it happens, but it's quite rare.
The manager of Bayern München, Uli Hoeneß, okay, he has been imprisoned for 5 years, so he could leave earlier, but for 40 million euro, okay. Yeah. So that's not, I don't think it's the case in German codes, and these dimensions are in the news for 5-6 years now.
Yeah,
and you get fed up with it. In particular, what the tax administration is not active. Okay, it's the prosecutor, and that doesn't go into my mind. Okay.
Yeah. Richard, do you want to make some concluding remarks? It's your book, your show, so.
No. Just what I'm conscious of is my attempt to summarize cum-ex in my 3 slides. That probably worked for some people and not others, but for those it didn't work for, then I apologize. I think you've got the idea that I should have used Philip's vending machine example and just cut the rest of it out, but that's what, apart from that, I want to thank everybody for tuning in, and particularly my panelists for agreeing to attend. I'm very grateful.
Thank you. Thank you, everyone. And with that, I think we'll conclude this, and everybody have a good weekend and stay safe and well, okay?